Alrighty then, ladies and gentlemen, welcome to today's Stock Market Brief Show. We got ourselves CPI data coming out tomorrow. So today's episode, breaking into 3 segments, we're going to talk about what the market's expecting as far as risk. We look at those expected moves. We're going to look at the current market conditions, which we do every episode, where we currently stand around some very important gamma levels. And then I'm going to talk about some interesting rotations, some charts that I'll give you some various ETFs that are kind of showing some strength. And we'll kind of just give some thoughts there. So all that and more on today's Stock Market Brief Show, which is brought to you by my partners, Interactive Brokers. If you haven't checked them out, make sure to check them out and make sure to click the Interactive Broker Campus to see all the tools, free resources that they offer. They're currently working on a new desktop application. They've been at various betas of it. I have it installed on my desktop. Works great. They have courses and so much. And then also the patrons that support this channel. They are the ones that keep me doing this. We have a swing trading community. I don't offer like a very expensive service. It's $9 a month, right? And you can save more if you just buy for the entire year. It'll cost you $90. And we have daily, weekly, monthly, quarterly expected moves in there. You have the entire suite of Tradie Ticks Discord bots, including the query channel where you can type in commands and get various data, options data on all types of different equities. I give my tight list, my weekly watch list. I do give some swing trade setups and ideas in there as well. It's by no means an alert service. That's not what I'm here to do, but I'm here to provide just additional tools and resources to hopefully get you in the right frame of mind when it comes to swing trading. Let's get into today's show. All right, everybody, welcome back. So there's a lot of information out there, right? We talked a lot about on yesterday's video some things that we've been seeing as far as inflation expectations potentially rising. There's a lot of different macro firms, people that talk macro narratives that we're going to be getting a higher inflation print. And this kind of makes sense. I mean, we've been seeing like the CRB index go up. We've been seeing a subtle pop in oil here. We've been seeing commodities, various commodities rising in price and copper, right? So you get these inflationary assets via commodities that are rising in price. You would think that we can potentially get a higher than expected inflation print. Now, consensus, what's the market going to do, right? These are just narratives, right? So I'm going to present to you some narratives here. Now, the core inflation rate year over year, the consensus here is coming in at about 3.1. So when people say, hey, I think it's going to be a hot print means that the inflation rate year over year is going to come in at maybe 3.2 or potentially 3.3%. And now if it comes in hotter than expected, right? Jerome Powell was out today, part of his testimony saying that he one of the main things that he mentioned out of the gate was that he believed that rates he's in no hurry to cut rates was the terminology that was used. Okay, so if inflation does come in hotter than expected, I mean, it puts him in a hard spot regardless. Like if inflation is upticking, you can't really cut rates in that environment. However, if it comes in cooler than expected, what's that mean? Well, it comes in at 3%, right? So that's the core inflation rate year over year. The same thing will apply for obviously inflation rate year over year down here. Consensus was 2.9. But if it comes in at 3%, right, that would be cooler than expected. So if it comes in hotter than expected, right, it means that we can basically guarantee here that the Fed is going to be keeping rates where they are. Perhaps we start to look at what the market's projecting as far as rate cuts into the future. Right now, we're looking at about 25 basis points of cuts. Okay, so maybe that goes away if it comes in hotter than expected. So then the market has to price in no rate cuts this year. Now, if it comes in at consensus, right, maybe the market's already priced it in, right? So we'll look at what the expectations of what this move is. And then cooler than expected, if it's coming in, maybe the market reprices and says, hey, I think that we might, instead of getting just 25 basis points of a cut, we may be looking at potentially more. Now, all that's narrative, right? It really is a narrative. So we got to just determine what levels make the most sense for us trading it more strategically, tactically, intraday, or if you're in a swing trade environment, if you're a swing trader like myself, we got to look at various market conditions. Now, today, overall, the market was rather mute for the most part, except for this guy over here, Tesla, which I did execute a trade into Tesla. I'll show you that trade right here. I did it. I talked about it on yesterday's video and then executed it live on today's trading session. I took a 1% position, so I'm not using a lot of capital. I am not planning on averaging down. It was just to get a piece of inventory in the in the account. And what I did here was I waited for the weekly expected move to kind of break here. And I entered in, I think it was 375.75. So right about here. And then we started getting some continued sell side throughout the day. And I was just looking at a 1-to-1 risk unit, right? One being why? Why? Because we're in a declining environment right now. There's a lot of volatility. So I'm not looking to have more than 1% of my capital at risk in a very volatile name right now. It's a very small position, as you can tell. And I'm not looking to average down and try to catch that. And so what I did here was just a 1-for-1. I think that the market can move back into the weekly implied move or back into the monthly implied move. And if it doesn't, it'd come down here below, I don't know, around 319, 318 and some change over here. Then I just get out if it just kept on going against me. So that's kind of the setup there. It was a 1-for-1, very wide stop, low capital intense position, given the context and the volatility. So that's kind of how I structured that. If we continue on and we look at the 11 sectors that make up the S&P 500, consumer staples led the way and energy right there below. We talked about energy's outperformance and what that means for markets on yesterday's show. So if you haven't watched it, go watch yesterday's show. Overall, rather mute as the market's kind of waiting for some important data. All right, so let's hop into what the market's expecting as far as risk going into tomorrow's trading session. This is a 15-minute chart of the SPY, and you can see today's price action. We gapped down and we closed a little bit higher, so we just kind of traded around to the side. As far as risk expectations go, if the market likes what it sees, maybe it comes in at consensus, right, and or cooler than expected. Maybe the market says, hello, we're going up higher. All right, that would be the daily implication of 609.58 up to and around 611.42. Now, these levels, they very well can break. But what's important to note here is if you look at the options change for the strike tomorrow, you have just an incredible amount of volume and money being traded within these levels. You have people reaching further out and people reaching in. It's kind of a tug of war to these kind of home-based levels. So they can act as magnets. And in last episode, what I shared with you was how frequently they are there to tag, okay? These aren't necessarily support and resistance lines, albeit you can create various trades in and around these levels when they come down to them, and even if they were to break said levels, right? This is just using mathematics to derive from the options chain to give us what the market is handicapping as far as forward risk. Now, remember, we say 68% of the time, right, it closes within these expected moves, right? Here's the weekly implied move. But if you really think about it, it's actually more about 70% of the time, the number doesn't really matter, but close to 70% of the time that you go and you try to strike for these levels. So chances are we will be moving and or exceeding these levels come tomorrow. And for the week, there's a high probability of us coming and or exceeding these weekly implied levels. So that's 591 below us, 610 above us. That is the S&P 500, the SPY weekly implied move. If we look at the Qs, this one's also rather large. What did we do today? We didn't do anything. Slightly down on the trading session. The daily implied moves for tomorrow's data can bring us down to and around, I'm just going to round it, 523. And this blue line down here, this zone, this is actually derived from the VXN, which is the NASDAQ 100 Volatility Index. You're dividing it by the square root of 265, and you're getting a daily output of what the daily implied move is for this stuff. So I like spitting these out because it gives us an idea, a range of where the market can take us based off of options chain, short term, and then also the volatility index. Pretty cool stuff. And now if you look at above us, if we start moving up into the upper weekly implied move, daily implied move, you have a lot of confluence up in this area. That's about 533 to 534 and some change there. So that's what the market's expecting. So if we come in at consensus, chances are we're going to be just coming in for one of these levels. If it's hotter or cooler than expected, there's a probability that we obviously shoot and try to overshoot some of these key levels. All right, what's the market conditions currently telling us? Right now, we're holding a positive above the gamma flip line. Okay, in yesterday's episode, we mapped out some key levels, and that happened to be 6,100. We had, I believe, 5,900 down there, and then we also had 6,000. We had some key components and levels that the market's been really kind of pinned in. Now, these levels on my screen, they're all concentrated areas of gamma. And it's important to note these because when you start to get heavy concentrated areas of gamma exposure, for example, over here at 6,100, this level is known as a call wall. And these call walls, when you come into these call walls, they can act as market pinning mechanisms. And if we start breaking from them, we can see volatility very quickly erupt, and we can kind of see an acceleration of a move away from these larger levels. And you could see that we came into 6,100 and we had DeepSeek news, right? Boom, we exploded from it. We came in here. We had tariff news. Boom, we exploded from it. Over here, we came into it, right? Actually, surprisingly enough, right when we hit it, we had a catalyst come. That was, I think it was like a Michigan consumer sentiment or something like that. We exploded right back from it. Okay, so the call wall right now, traders are focused in right at about here at 6,200, but we got this level over here at the JPM collar. It's just above 6,160. 6,165 is what it's at. That's an important level of gamma exposure. And then we still have 6,100 that we've been struggling to break through. Now below us, right, what do we got? Well, we got 6,050 right over here. And then we have below that, we have 6,000. And these levels aren't nearly as big. Below that, we got 5,900. So there's some concentration up in this area as far as the put exposure goes, and these put walls, right? These put walls can act as potential levels or areas of support if the market were to come down there. So in short, what does this mean? Well, once again, being in positive gamma, this is where dealers look to buy the dip, sell the rip. We'll call it, it is technically above the flip line, but just note that how other people aggregate their data, they can potentially call this just gamma neutral. So it's more of a pause state, which you kind of see what price has been doing. If we can hold above this, I'd be bullish to 6,100 and potentially to break it. If we start cracking under the gamma flip line and below 6,000, it opens the door beneath us. So we're really at this inflection point in markets. The next thing that I like to look at is the direction of these 5-day moving averages. So currently we're above a rising 5-day in both the SPY and the Qs, and also semiconductors started participating here. Biotech is taking a little bit of a hit. DIA turned green, but it's rather flat and choppy all around. And then IWM's currently red, but it's really just flatlined over here too. So we're in positive gamma, check for the bulls. We're above these rising 5-day moving averages for these big index products. Boom, check for the bulls. So this is all positive stuff. Unfortunately for us is that we are kind of on that neutral level where something very abruptly can happen. So I am leaning more bullishly. However, you get a print tomorrow that's hotter than expected. All of a sudden, things change. Fingers are snapped. It's over and done with. So we have to readjust and approach markets in a different manner. Okay, I want to talk about some interesting rotations here because not all of it is just trading the S&P 500 and looking at the Qs, but there are some interesting things going on from a more defensive standpoint. And I think it's worth noting because if we get continuation of this, this could mean that you want some exposure into these areas. The last time we really kind of talked about some more defensive areas was consumer staples, which happened to be the low of when we actually were discussing it, which happened to be lucky. But right here, I'm showing you rotation charts. Okay, this is relative strength lines. A relative strength line is just telling you on these ones specifically how a specific asset is measuring up against the S&P 500. So when any of these lines are going up, it means that the asset that I'm measuring against the S&P 500 is outperforming that market. Okay, and what do you see over here, right? So this line has been going up. The blue line is the 50 EMA, right? Just to give you an idea of direction of trend. This right here is gold relative to the S&P 500. So what is, I mean, gold is outperforming the S&P 500. That is a very interesting thing right out of the gate. Is that defensive? I mean, historically, yes. So gold has been outperforming the S&P 500. This over here is utilities, and utilities has always been known as more of a risk off type sector. And you can see that it has been trending down, but in recent, right, from 2025, we've been rather flattening out, and we're starting to try to get back above a flat 50 EMA over here. And I'll show you an interesting chart on utilities from an absolute basis. But right now, this from the January 27th, we've been seeing a little uptick here, having utilities outperform the S&P 500. Take a look at consumer staples, right? It's been below a declining 50 EMA, the relative strength, but recently, since the middle of January, we've been seeing it uptick, and we've recently crossed back above that 50 EMA. Is it going to hold? I have no idea, but that is something interesting and more of a risk-off factor here too. Now, one thing that I will note here is bonds have historically been a place for safety, right? If you go back through history, people flood to bonds for an area of safety, but these last few years, right, that's just not been the case. On in terms of when you see markets kind of correct themselves, like in 2022 and so forth. But TLT, right, has been getting completely hit to the downside, and it's below this average. So it's still telling us that the markets, the stock market, is outperforming the bond market over here, and we're using just TLT as the proxy. However, we are up from these lows over here in the middle of January, and it came up a little bit. We're kind of rejecting here. But if we were to see a sharp increase in the relative strength between TLT and S&P 500, that may not be the greatest sign once again for the markets. And perhaps if that does happen, it may kind of revert back to that old style, right? Old quote unquote flight to safety, which is just not happening yet. We have healthcare relative to the S&P 500. This one's been kind of increasing here too, back into the 50 EMA. That's starting to flatten out. It was in a decline, starting to flatten out over here. And then you have POWA. I believe that this used to be DEF, which is more just a defensive posturing ETF. And you can see since 2025, we've seen an uptick here. The 50 EMA is flattening, and we're starting to kind of just go sideways here on the relative strength line. So the interesting part that I'm trying to point out here is you're seeing some rotations in the very short term, right, into more of a safety type trade, right? But there's other factors going on too as well, and other just different industries and sectors. So here is ETF. This is ITA. ITA I'm showing you right now because it is coiling up, right? And I look for names, stocks, and or ETFs that are in a period of contraction. And this one, from the year to date, it went sideways, and boom, we saw a massive move. It's at roughly highs, right? Near high. I don't know if this is all-time highs, but it's at highs. And we are in a nice period of consolidation over here above rising 20-day, 50, above the year-to-date volume weighted average price, above our inclining 200-day. So right here, you have volatility contracting, and this looks like a good risk-to-reward opportunity to potentially have some continuation. And this right here is a aerospace defense ETF. So if you want to, Google ITA, right? And then look at the holdings that are within it, and you may see individual equities that you might want to get exposure to, and or just an ETF. All right, you just got to do your kind of research there. So ITA, here's another interesting one. This is SPLV. Now, this is an ETF as well, but it's focusing in on low volatility. And that to me is kind of interesting because right, the market's all about risk, and if low volatility ETFs are going to be outperforming, it does scream a little bit more defensive. And what do we see from a year-to-date perspective? Well, we started down, but we recouped. And what do we see now? Well, today we started breaking out of a little pivot over here. We've been seeing a series of higher lows. We do have a declining 50-day, rising 20-day above a year-to-date, but this might be something to pay attention to, because if low volatility names are going to be what's performing or holding up better for however long until things start to change, it could be an idea and giving us some insight saying, hey, instead of focusing on higher volatility names, it may be time to focus on lower volatility names. Okay, there's also iShares Russell 1000. This is IWD. This is a value ETF. So once again, it's typically lower volatility. A lot of the value names can be lower volatility. I would encourage you to look at what the holdings are in IWD, because there's probably some high beta ones too. But this is looking at value names. And this is interesting because here's where we started year to date, and we basically went straight up. And now we're just consolidating over here. As it stands, we're below this 195, 196 pivot area. But value names are holding up right now and using IWD there as the proxy. So this could be another area to kind of focus in on and look at for potential opportunities. So out of the gate, we have defensive names being rotated into, right? We have low volatility names being rotated into. We have IWD, which is value names, also being looked into. I talked about utilities a little bit ago, and this is one of the trade ideas I posted, but some of the utility names have been looking rather good, right? They've been going through a period of contraction, and sometimes they can expand to the upside. Now, in the short term, XLU, right? If we draw out this little channel, right, we have a low connecting a low, connecting a low, connecting a low, connecting a low. Move this channel up to here. And then what I've noticed was we kind of broke to the midpoint of the channel and we started getting very, very tight over here. Now today, on the last minutes of trading, we started to press a little bit higher. So perhaps utilities might be setting up for a move here, so you can look at some individual names or trade an ETF. But utilities, which happens to be more of a risk-off environment, looks pretty good here too. Now, I want to note that it is also potentially, right? Some people might look at this and say, well, it's actually kind of just flagging. It might break back down. I'd say, yeah, I agree with that, but it hasn't right yet. And it's still holding up some key levels. Now, here's another one too. So if you still like riskier assets, right, this is a momentum ETF, which focuses on the names that obviously have a higher momentum. Like we've been seeing things in Broadcom. You've been seeing it holds NVIDIA. It holds all kinds of different stuff. So the ticker here is SPMO. And SPMO down here started the year, came in a little bit, and it's been holding up rather well up in these higher areas. So if we start seeing pullbacks here, right, because I believe it also holds Meta and various names like that in the top holdings, you'd want to look. But momentum names are performing. The reason why I'm showing you this is because this is at basically highs, right? Whereas if you look at the Qs, it's been getting held back. If you look at technology, XLK, that's been being held back by various names as well. So you may look into something like the momentum ETF, because this has been what has been overall performing. I was trying to look up a various like cybersecurity software ETF. I didn't come up with anything out of the gate, but various cybersecurity names like what we mentioned, I forget which exactly one. CrowdStrike, right? It's been holding up rather well. FTNT is one that's been holding up decently. I think FFIV was Cyber, right? CYBR was one that we've been watching for a while here too. So there are a lot of different interesting rotations going on, but I wanted to call these out. Like an hour before the market opens up tomorrow, be ready for that report. We have Powell continuing his testimony. These markets are priced to get moving here in the very near future. So just be on the right side of trade when that obviously takes. And if you're on the wrong side, just don't fight the tape. Just be ready for the next opportunity. That's all I got for you. Hope it helps. See you later.